we are covering the efficient market hypothesis, or EMH, a key concept on the Series 65 exam. The EMH asserts that financial markets are efficient, meaning stock prices fully reflect all available information. For the exam, you must know the three forms of this theory: weak, semi-strong, and strong. The weak form states that all past prices and trading volume are already reflected in the current stock price. This means that technical analysis, which relies on historical price patterns, is useless for achieving superior returns. However, fundamental analysis, analyzing a company's financial health and economic conditions, might still provide an edge. An exam question might ask which type of analysis is ineffective under weak form efficiency. The answer is technical analysis. The next level is the semi-strong form, which claims that all publicly available information is already priced into the stock. This includes past prices, plus all public data like earnings reports, financial statements, and news announcements. Under this form, neither technical nor fundamental analysis can consistently produce excess returns. The only way to gain an advantage is through access to non-public or inside information. A common exam scenario will test this by asking if a portfolio manager can outperform the market by meticulously studying a company's 10K report. According to the semi-strong form, the answer is no, because that 10K is public information and already reflected in the price. Finally, the strong form of the EMH posits that all information, public and private, including insider information, is fully reflected in the stock price. In a strong form market, no one can consistently outperform the market, not even with illegal insider information. This is the most extreme version of the theory. A key implication of the EMH, especially the stronger forms, is the debate between active and passive management. If markets are efficient, it's nearly impossible to consistently pick winners or time the market. This leads to the conclusion that a passive investment strategy, such as buying an index fund, is superior to active management. Active management, with its higher fees for research and trading, becomes a losing proposition if all that information is already priced in. The exam will test your understanding that a strong belief in EMH supports a passive, index-based investment approach. This is closely related to the random walk theory, which suggests that stock price movements are unpredictable and random. If prices follow a random walk, then past movements cannot be used to predict future movements, which aligns perfectly with the weak form EMH. For the exam, a common trap is confusing the different forms. Remember this mnemonic: PPP. The weak form reflects past prices. The semi-strong form reflects public information. And the strong form reflects private information. Weak, semi-strong, strong. Past, public, private. The exam will present scenarios and ask you to identify which form of EMH is being described or what its implications are for an investor's strategy. Understand that the core idea is about what information is already baked into the stock's price and, therefore, what type of analysis is rendered useless. For free practice questions, AI-powered explanations, and more exam prep tools, visit openexamprep.com. That's openexamprep, all one word, .com.